there's a couple groups of people here tonight. So we have Brian Terry. He was on the podcast a few episodes ago, so you may have recognized his name or his voice. Brian and I met a few years ago. He started the Central Florida options trading meetup, which was off meetup.com. It was a live group. We used to meet at the library once a month, and we would go over basic concepts and share ideas. And when COVID hit, Brian basically switched the local meetup to a Zoom meeting. And over the past year or so, he's just been running these Zoom meetings, and I've kind of been participating when I can in those. And he also has a Facebook group called Winter Park Options Trading, where we're from, but I think it's called Central Florida Option Trading. But long story short, we were talking this week and just kind of decided to, since we're doing all this online stuff, there's really no reason to not open it up to everyone else. So some of the people in this group are from the options trader meetup, and then a lot of other people in this group or on this call tonight know me from the stock market options trading group, and vertical spread option trading, the Facebook group, and then the YouTube and that kind of stuff. So we're kind of just mixing everybody up tonight, and I wanted to kind of just show you how we're going to maybe operate this moving forward. So if you're not in the new group already, we welcome you to join. It's totally free. It's kind of like Facebook, but it's not Facebook, which is a good thing. There's no ads. It's just a lot cleaner. There is a mobile app if you want to join that too. So I'm going to go ahead and share my screen, and let's talk about, for those that are not in the stock market options trading group, you can go to stockmarketoptionstrading.net, and you can set up a free account. And this is where we're going to be kind of announcing a lot of the meetings moving forward. So under the events, this is a new tab over here. Under the events tab, we'll be posting a new event probably every month. Brian's going to be managing that. He's got a lot of really good guests on. We had Tom Sosnoff on like a couple months ago. We had a Kai Zhang from Tasty Trade, one of their data research guys, was on giving a presentation. So we've got some pretty good speakers. I'll be doing some things, and I think people will be able to request like, hey, I really like to learn more about credit spreads or whatever, and we can present something like that. Brian's a great trader. We've got a lot of good traders in the group. So I wanted to just kind of, if you're in the meetup but not in this group, invite you guys over to join here over at stockmarketoptionstrading.net. And if you're already in this group, I'll let you know that we've added this events tab. One of the cool things we're starting here in this group, we started a few weeks ago, called Winning Wednesdays, and it's a topic. So when you post here, you can add a topic, and basically you go to topics, we're building this out. If you go to Winning Wednesday, basically every Wednesday we're having people share either their own post I usually try to send like a reminder post, and people are just sharing how they're making money in the market right now, and everyone's doing it a little bit different. It kind of opens up the conversation to what's working. You guys, for those who've been following me, I trade a lot of SPX, but as you know, there's 1,000 other things to trade. So I like seeing what other people are doing. Some people are buying options. There's selling naked puts, and there's just all kinds of ways people are making money. So we're in the current market. So every week people are posting here, and you're able to go back in and just kind of look at anyone who posted and added this topic. You can scroll through and see, what they did, how they traded, and, kind of just join the conversation, ask questions. We're trying to make this community, way better than Facebook. We don't, everybody's real positive here. And that's part of the admittance fees, that you have to be positive. So if you can do that, we want to invite you over. So
Eric, the only thing I'll just add is we'll leave the meetup. You'll get invites through the meetup as well, but it'd be a whole lot better if we could get everybody kind of switched over. Then we have our own community, not kind of, it's kind of all focused on option trading. And, when we have people from all over, which is great. So, and they're certainly welcome to keep coming. We like having different people, from different parts of the country. That really makes it a lot of fun. And we'll decide once we can meet in person again, how are we going to do it? But that seems to be a little bit of a ways off.
Brian, are you able to monitor the chat as we go for people who want to ask questions?
Yeah, I'm doing that.
Okay. Yeah, so we're gonna talk about kind of a basics of risk, and I want to kind of frame trading stocks to options to spreads. A lot of people get kind of stuck in that transition and they start in options in a certain realm, but we're gonna take it back to trading stocks and just how that relates to the risk and how we can see that. So this is a relatively basic presentation, and we're just going to walk through the trading platform. I'm going to kind of show some things, and then I'll, if you have questions, put it in the chat, and I'll pause from time to time to go through and try to answer any questions. So, all right. So, are you guys able to see my screen? Right. Okay. So I'm going to minimize this, and okay, minimize that. Okay. So what we're going to kind of start, I'm just going to work with Apple tonight. I have no opinion of Apple, really. I don't really trade Apple, but I figured that was a good starting point. And what we're going to do is just look at the price chart real quick. And this is how most people see stocks. This is the basic chart where this axis at the bottom is time. So you have June, July, September, October, December. And then the y-axis would be, is that the X or Y? I forget. Anyway, the up and down axis is the price, right? So typically when you buy a stock, you want it to go up and you sell it for a higher price later. So everyone kind of gets that basic understanding. But what we're going to do is kind of do the same thing, but we're going to flip it a little bit. We're going to use a risk profile tool. I'm using Tastyworks tonight because I like the way it looks, but this is also in Thinkorswim. In Thinkorswim, you can find this tool in the Analyze tab, and you can add simulated trades and kind of analyze what that trade would be, analyze your risk. And that's what we want to focus on tonight is looking at the risk and compare that risk between stocks, options, and spreads. And we'll kind of mess around with a little bit with that. So this is the risk profile tool, and Tastyworks, they call it the curve, and it actually hangs off the trade tab. And this is where also you can find the option chain under the table, or you can go to the curve. They allow you to add trades to the curve here. But basically the price chart is now, the price of the stock is now sideways. So you can see Apple closed today about 133.50. So this little green flag is where the current price of Apple is. So we're looking at this after the close. So during the day, this thing will start moving back and forth. But as opposed to the price chart, now when the price of Apple moves up, it's actually going to go to the right. And then when it goes down, it's going to go to the left. So it's a little bit different view, but what this is going to do is allow us to see our risk once we decide what kind of trade we're going to do. So first thing we're going to do is just simulate buying 100 shares of Apple. And all I did was click on the ask. It defaults to 100 shares. And this is what your risk is when you buy a stock. I'm going to zoom out a little bit. Basically, when you buy the stock at 133.50, and I'm just going to lock this price in, and there's the bid and ask spread. I'm going to move this up to 133.50. So basically, it's pretty binary, right? Like two things can happen. The stock is going to go up, and you're going to make money, or the stock is going to go down, and you're going to lose money. And this particular view of it is going to factor in your position. So if you have 100 shares and the stock goes from 133.50 to, let's say, 135.50, you can see in this little flag here that the theoretical price here is I would be up about $200, right? So that makes sense. If the stock is at 133.50 and it goes up $2 and we have 200 shares, we're going to make $200 as soon as we close the trade. What that is called, or one thing we want to start talking about, is delta. Delta is an option Greek, but it's also your position. It doesn't always have to be an option. Whenever you're in a trade, you have a particular amount of delta. If you buy 100 shares of stock, you have 100 delta. And what delta means is for every dollar that the stock moves, you would make, each delta would make $1. So if you have $100 and the stock moves by $1, you would make $100. If I decide to only buy 50 shares of Apple, when the stock goes up to 133.50 to 135.50, now I'm only going to make $100 because my delta is 50. So another way we sort of talk about this is we're saying we have long deltas in Apple, meaning we are long Apple. We have positive delta. So if the stock goes up, we will make money. However, if the stock goes down and you have positive delta, you start to lose money. And this kind of simple graph sort of shows you how much you can win or lose depending on where the stock goes over over the time period. The other thing I want to point out here while we're looking just at a general stock order is the POP. POP is the probability of profit. So tastytrade is telling us that if you buy a stock, you have a 50% chance of profit because there's really only two things the stock can do, go up and go down. Now, obviously, if you factor in your own analysis and maybe you're watching the chart and or whatever, you can, you can beat that, obviously. This is just giving you sort of a mathematical probability. The other thing we're going to look at is our max loss here. So if I buy, I'm going to go back to 100 shares because all options are based off 100 shares, right? So if I buy 100 shares of Apple and the stock goes to zero, my max loss is going to be $13,350. Okay. Now, we typically know that Apple, or at least inherently know that Apple is probably not going to go to zero. So our risk really isn't that much. But in theory, it's, max loss is something when we start trading options that you're going to want to understand, because options, you could get a max loss, and it's something we'll talk about in just a minute. But I wanted to point out that there is a max loss when buying stocks. The other thing is the buying power, and this depends on what kind of account you have. So even though if I bought 100 shares, I'd be buying $13,000 or so worth of Apple, the buying power effect with tastytrade is $6,675. This is a newer account, it's a margin account. So I don't need the full $13,000 to buy the 100 shares. They're going to let me buy it on margin. However, if the stock starts to go down and I don't do anything and it starts getting cut in half, I might get a margin call and they would close those shares for me. I've never had that happen, but in theory, your buying power effect, this is the amount that's required in your account to basically place this trade. So this is just a quick example of buying 100 shares of a stock, and you can kind of see the risk profile. We have positive delta, 100 deltas. So I'm going to flip it. Let's go to the chart of Apple real quick. Let's say you think Apple is going to go down. There's ways you can get short delta, or you can short Apple. And if you're doing that with stock, you could simply short or sell short the shares, right? So this basically flips the risk profile basically in the opposite direction. So now I have negative 100 delta. Well, what that means is if the stock price goes down, I can make $100 for every dollar it goes down. If the stock goes up $1, I'm going to lose $100 because I have a negative 100 delta. My max profit on a short can actually be the entire $13,000. If the stock goes to zero, then I could basically buy the shares back for zero. If you sold something for $13,000 and you buy it back for zero, you made $13,000. So I don't want to get too caught up in shorting and all that stuff, but just want you to understand the concept of being long delta, meaning for every dollar that the stock moves, you'll make that many deltas. So if you're long, if you buy 20 shares and the stock goes up $1, you would make $20. And it's opposite. If you have negative delta, you actually make money when the stock goes lower. So with that, any questions about? See.
Hey Eric, a question. So it doesn't really matter if you're buying $100 stock or a $10 stock. It's still the same delta. Like
correct.
Okay.
Yeah. So Apple's $13. Let's say I bought. Let's find something. I think I had Palantir on here. It's a little cheaper. So Palantir is $22 stock, right? If I buy 100 shares of Palantir, I still have a delta of 100, because delta means for every dollar the stock moves up, you'll make that much in your delta. Your delta is how much you would make. So, but the thing is, for Palantir to go up $1, that's like a 5% move, right? Whereas like Amazon, if you buy, Amazon move, I don't know if I have it over here. Amazon's a $3,000 something stock. So it's going to move $60 or $70 in a day. But because it's so expensive, if you were going to, buy 100 shares of Amazon, it's going to cost you a lot of money. But if you buy 10 shares of Amazon, you can still have 10 delta. But since it moves $50, $60 a day, then, you're, I don't know if that helps. It's delta is the same no matter what. When the stock goes up $1, however many deltas you have, that's how much you would make. Or if the stock goes down $1, if you're long delta, that's how much you would lose. Mm-hmm. Does that help?
Yeah, I always just thought it was interesting that a delta based on the price, but that's a great explanation.
Yeah, and you'd think, and we inherently know this, right? If you buy 100 shares of a $20 stock, and now my max loss, is $2,000, for you to make, even though you have 100 deltas in Palantir, if the stock goes up, 10%, which is a big move, right? If stock goes up 10%, it goes from 22 to 24, let's say, you're only up a couple $100 or $140 or whatever. So even though you have the delta doesn't dictate, like you can have the same delta exposure to a stock, but the stock itself and how much it moves is going to dictate how much money you make or lose too. So got some more people coming in. Okay. Any questions about just delta and when, this basic risk curve for the stock? Okay, cool. All right, we're going to keep going. So I'm going to go back to Apple. Let's go back to the chart. So buying the stock is one way to get long Apple. Another way to get long Apple is with options, and there's a ton of ways to do it. But again, we want to focus on comparing that delta with the risk, and we're going to do that with the risk tool. So let's just say I am looking to get long Apple. I think the stock's going to go up. I could buy the shares, but as we saw here, I'm going to need at least $6,000 to get 100 deltas of Apple, right? I could buy 10 shares, but if the stock goes up $10, I'm only going to make $100. So I still want to try to get 100 deltas, but I don't want to pay $6,000. Okay, so this is where options come in. This is why options is so popular. You're able to leverage your money. And let me just repeat, I don't think this is a good trade, but please don't go out and buy call options on Apple tomorrow. That would, especially with earnings coming up, it's probably a horrible idea. But let's go to the trade table, and this is the options chain. And I'm just going to go out 30 days to expiration. And if you're new to options, options are contracts. They are born and then they die, and they die at their expiration date. And when you go to the option chain of a particular stock or ETF, you're going to see all the days to expiration. So I'm just going to go out 30 days, and I want to get 100 deltas of Apple, but I don't want to pay $6,000. So I'm just going to, look at basically the at the money strike. So if the at the money is basically saying if Apple's at 133.50, at the money is either 133, 134. And you can see the delta column here, where the delta for each strike price, each one of these is a contract. And you can choose how many deltas you want. You can buy more than one contract. So I'm just going to choose the at the money. I'm going to buy the 133 call. And you can see that costs about $5. Now, keep in mind that all options are based on 100 shares. So you have to multiply this by 100. So you can see my max loss is $500. And the buying power is effectively $500 as well. That's all I need to get 53 deltas. of Apple. So since I'm trying to get 100 deltas of Apple, for this example, I'm just going to buy 2 contracts. So 2 May 21st, 133 call options with 30 days expiration. I now have 105 deltas, so it's very similar to buying 100 shares of stock, but there's some other factors here. Now, the first thing we'll notice is the benefit, if you will, is I only need to spend $1,000 to get 105 deltas. I don't need to spend $6,000 on margin that I did with the Apple, buying the actual stock. But now we have a couple other things here. We have theta. Theta is a time decay that works against the options. So these are 30-day options, and all the options have a little bit of we call it premium or time decay in it. And over time, each day, this $1,000 will lose about $15 a day over the course of the 30 days. And this can change on a daily basis depending on where the price moves. So when you buy that option, you're able to save money with the amount of money that you are having to lay out to get those deltas. But there's now some things that are working against you, and theta is one of those. The other thing we'll notice is the probability of profit is no longer 50%. And the reason why is because even though I'm buying the 133 call, what that does is that gives me the right, not the obligation, to buy Apple at 133 in the next 30 days at expiration, right? So what that means is if the stock goes to $140 and I have a contract that says, hey, I can buy this for $133, that contract has increased in value because it's obviously allowing you to buy that stock at a discount. And that's basically what, option. I mean, there's different ways to do it, but that's the general reason why when you buy a call option, you have the right to call the stock away at a particular price. In this case, we're talking about the 133 strike. So let's go to the curve and see what this looks like. So this has a similar curve, halfly similar, I should say, as buying the stock, whereas if the stock goes up, we can make money because we have positive delta. But you'll notice here that at expiration, if the stock does nothing, you'll actually lose the $1,000 because that's the premium and the time decay that's built into that. It lowers your break-even point. The break-even point with this call option is now at about $138. So when you buy that call option, and obviously you can buy them up and down the chain and there's different deltas and things. When you buy that call option, you have to have the stock move in your favor or you could lose the entire amount of money. So you're in essence risking more of the capital you laid out. So we're risking $1,000, but there's actually a likelihood you could lose the entire $1,000. And that's basically if the stock does nothing. But at the same time, if we go to Apple and let's say we were wrong and the stock drops to $120 for whatever reason over the next 30 days, then the most we can lose is $1,000. We don't lose more as the stock goes down. Whereas when we bought the shares, we continue to lose all the way to zero. So this minimizes the risk in the trade. So the most we can lose is $1,000. No matter what Apple does, the most we can lose is $1,000 if we were to buy these 2 contracts. But we're basically buying positive deltas. So if the stock does move up, we can participate in that. But again, it has to happen in the next 30 days, and it has to happen. We have to get above 138 ultimately to make money at expiration. So that's kind of comparing buying shares of stock to buying a call option. So are there any questions about that so far? We're going to look at selling that option in a minute, but any questions about buying options?
Hey, Eric, question for you.
Yeah.
Comparing the buying options to the buying the stock,
Yeah.
If you had allocated $6,000 when you bought the stock and only $1,000 when you bought the option, right? So what I'm wondering about is money allocation, right? If I'm buying a stock, I might not be afraid to put all of my money at work because it's how much can the stock move, right? But if we're talking about buying options, I would be afraid to put all of my money to work. So I might only put 10% of my account active into options at a time. So what are your thoughts on your money allocation? How much is working for you at any given time with options like these long type call options compared to the stock?
Right. Good question. So the way I think about that is options are leveraged. So even though you're only putting $1,000 out there, you're more likely risking 100% of that capital. Right. So if you buy, and let's go back to the stock example. If you buy 100 shares of Apple and the stock goes down to 120, right at this level, we'll call it 122, you'd be down $1,000, right? So you wouldn't be out your entire $6,000. Let's say you put a stop at 122, for example, and you would need $6,000 to take that trade. But as the stock went down, you would get stopped out at 122 and you would lose $1,000, right? So if you were wrong. But if for some reason you didn't have a stop or you weren't paying attention, you could actually lose a lot more. So you have more risk on the table. And the way I see it is whatever you're putting your money into, that risk is on the table. So by using options, you're able to minimize the risk, but the probability is lower. So this is a higher probability that you'll make money, because if the stock does nothing, you don't lose. So I think when you start comparing them, you really got to factor in the probability factor, which is, I know but we got to factor in the probability of making money. So even though you're in the call option example, if you're risking $1,000, for example, if the stock doesn't do anything, you're at risk of losing that when the stock does nothing. But with buying the stock, you need more money to do it, but the likelihood that you lose is less by the probability of profit here. That's kind of how I see it. I don't know if that anyone else has any. Brian, you have any comments on that, or what do you think about that?
I mean, that's a great explanation. I think the difference is it has to move that, $5 before you make any money. Where if you just bought the stock and it moved up $5, you'd make $500. So you kind of start behind the 8 ball with the options, even though it's a lot cheaper to get into, call options. So that's kind of the way I see the difference is, when you start at that green starting flag, you've got to move, a pretty far distance just to get into the, where you start making money.
Yeah. So that you brought up a good point. Let me add this is the P&L theoretical line, and some people call it the T line or the delta line. As you can see right now, if I were to buy these two call options right now, the T line, the theoretical line, is right at the break-even point. And what happens over time between the theoretical line and let me take this off. This is the line at expiration. This is the risk profile in 30 days. Wherever the price is, this is how much you would make or lose. But in reality, this is a little bit closer to what would happen tomorrow. So if the stock were to shoot up to 140 tomorrow, you could make a few $100s. You'd make a lot of money. But over time, this orange line is going to conform to the risk profile line. And this is why you have negative theta. When you have the theoretical line above the risk profile, over time, the negative theta is going to reduce these losses by approximately $15 a day. And over time, that orange line is going to conform to the expiration line. So this is the profit and loss right now. This is how much you would make right now, but this is at expiration. So I guess where I end up is your timing has to be really good. So if the stock shot up to, let's just call it 140, and let's say tomorrow you would be up about let's call it $950. But if the stock stayed there at 940, that time decay is still working against you. And that orange line is going to slowly come down, and you would only make $400 at expiration. So even if you're up in the trade right away, if you don't take that profit when you have it, you can continue to lose money. It's only until you get way up here because as you, and we're not going to get into this today, but as you move, as the trade goes in your favor, your delta actually increases. So if the stock went up here, you would have a greater delta. And over time, if you got really far in the money, it becomes like a stock replacement and you have no more premium and it's all intrinsic value. That's a little bit beyond what I wanted to get into today. But if you do get the timing right, and this is why people are so attracted to options. If you time it right, you can make a lot of money very quickly. But you just have to know when you buy options that you have this time factor working against you, and you need this to go up, soon. You need it to go up because you're not going to, most likely not going to hold it to expiration. Excuse me.
Hey, Eric, the other thing I was going to add is you did a 30-day. So the first, 10 days of that contract, it doesn't go down as rapidly as it does like the last 10 days. So
Yeah, time decay sort of increases over time, but then it also depends on where the stock is at. So if the stock rallies up here, your theta is going to, I think, decrease a little bit. I could be wrong. I might have to check that. I don't want to get too far in the grease because I think it's, I just wanted to kind of show comparing the two and what the risks are. But yes, if you don't get the move you want in a timely manner, you can lose money trading options, buying options, I should say. So let's go back to the chart and let's flip this around. So we know if we buy a call option, we know that we would make money if the stock goes up in a timely manner over that particular period. But another way to trade options, and this is the intrigue for me, is basically options allow you to express whatever view you have about a particular stock or market or whatever. It's more than just having things go up and down. It's having things not go up. It's having things not go down. It's having volatility, and there's a lot of other aspects to it where you can get creative and really kind of express your view. So if I'm looking at Apple here, and let's say I'm not one to short stocks, which I've never really shorted a stock actually, but at the same time, Apple's just been in this big channel, and earnings are coming out, and Netflix tanked, and I don't really have a lot of confidence that. I don't think Apple's going to go above, let's call it 145. So I now have an opinion, and this is not a real opinion, by the way. I'm just making this up. So do not go into the market tomorrow saying, oh, Eric said Apple's not going to go to 145. It could very well go to 145. But my point is, once you have an opinion, you can then express that opinion. So it doesn't have to be as much as saying, hey, I think Apple's going to go down, so I'm going to short it, or Apple's going to go up. I'm going to say, you know what? I just don't think it's going to break the new highs over the next 30 days, right? I just think it's going to stay above 145, and maybe I don't think it's going to go below 105. Maybe I just think it's going to keep doing this for a while. Well, there's ways to express that opinion and make money on it if you're correct. So in the example of saying, I don't think Apple's going to go above 145, I can express that let me clear this out, by instead of buying the call option, I could be a seller of a call option, and I can go out, we'll just stick with the 30 days, and I could go to 145, and I could sell this call option for, $116. So let's look at that on the curve. So here's the 145 strike. If I'm right, and I sell this call option and Apple stays below 145 over the next 30 days, then I get to keep $116 no matter what the stock does at any price. I'm basically just drawing a line in the sand that I do not think the stock is going to go above 145, or at least I should say, expire, close above 145 over the next 30 days. And I can make money from the stock doing nothing. And this is one of the big benefits of options trading. This is why a lot of us end up being net option sellers, because we can get a little bit more of the probability in our favor. And you'll notice the probability of profit now is 84%. So it was more than buying the call option, although we bought it at the money option, and it's greater than buying the stock. There's a high probability that we would make money on this trade. The P50 is the probability of making 50% of this. So just like stocks, with options, you don't have to stay in the whole time. You can buy an option tomorrow and then sell it in 3 days. You can get in and out just like you can a stock. You don't have to hold it to expiration. So if we sold that call option, let me go back to the chain, this particular option has a delta of 18, right? So if we go to the curve, if we sold that, we now have a negative delta. So if the stock actually starts to go lower now, we're going to make money sooner, and we don't have to wait for the time decay. You'll notice now by selling the option, the theta, the time decay is in our favor. If the stock does nothing, we can make $5 a day on this one contract in general. But we also have negative delta. So if the stock moves lower, we will both make money from theta and make money from having that negative delta. And the value of that option will no longer be $1.16. It could reduce in value to say, let's say 80 cents. So then you could then buy it back for cheaper. And that's basically the goal when you sell options. You want to sell something for one price. So if we sold this for $116, and then over the course of the next couple of weeks, it's now only worth $80, we can buy it back and we can net that $30, $40 change. So this is just one way to express your opinion in the market. But again, we want to look at the risk. Just like shorting the stock, if we're wrong and the stock shoots up, we have a lot of risk to the upside here. Like we're risking $116. If we're really, 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 really wrong, we could lose thousands of dollars because we don't have any protection up here, and the stock can go up, as much as it can go in 30 days. So we want to keep in mind the risk. Even though this is a high probability trade, if we're wrong, there's a lot of risk here. So one of the things that we do to minimize the risk, and now we're going to kind of get into spreads, is by selling this option. This is referred to as selling a naked call option. And when you sell naked, you have a lot more risk. Notionally, you have a lot more risk. Some people will argue with that statement, but so the other thing we do is we could say, okay, well, I don't want all this risk. Let's say I don't want to risk $2,000 to make $100, right? Maybe I'm willing, if I have a high probability, maybe I can risk a lot less. So one of the things we can do is create a spread. And we do this by selling one option and then buying another. So I'm just going to randomly pick the 150. So if we sold the 145 for $1.16 and we bought the 150 for 64 cents, we're going to be able to collect that difference. So now we've reduced our profit. But if we go to the curve, we now reduced our risk. Now we're only risking $400 and something, but we've cut our profit in half too. And we have a very similar amount of probability of profit. So now what you could do is trade two of these. So if you still want to try to make $100, you could trade two of these instead of selling the naked option. But again, you still have negative deltas, positive theta, but it's reduced because you've created a spread. This is a vertical spread. A vertical spread is a spread where you sell one option and buy another option, both of the same option type and in the same expiration. So this is a vertical call spread. Since we've sold the spread, it's a credit spread. We receive a credit. Obviously, if we flipped it around, you could buy it and it would be a debit spread. So, so this is a little bit about, visualizing your risk and your reward, and then you making that determination for yourself. What's your conviction and your opinion of the market? And are you willing to risk this much to make this much with this type of probability. And that's really the game that we play as options traders, is a game of probability. And a lot of us end up selling options because it tends to give you a higher probability of profit. Any questions about that selling options, versus the spread or anything?
Hey, Eric, one thing is I see on this parity chart that the earnings are coming up. How are the value of these options affected by those earnings before, during, and after?
Well, the 30-day options probably won't be affected that much. And again, this is probably a horrible trade to put on right now because you do have earnings risk. Probably more delta risk with the earnings than you do anything else. But let me see. I think it shows here. You can see the volatility is greater, but if I go out, it's a little bit less. So that's one way to trade options. As some of you may know, where when the volatility is really high and you think it's telling us the expected move. When is that earnings? 28th. So April. Yeah. So these options would have the most risk, because if we go back to the chart, if Apple were to rally very hard during that time, the call options are going to increase in value, right? So at this point, the volatility increases and therefore the premium gets more, and you can sell options and get a little bit farther away from the money. A little bit more advanced than what maybe we were wanting to get into tonight, but basically the volatility increases with the options around earnings because the expected move is unknown. So the options market tries to price in something with the expected move, and then there's a volatility crush. So you can actually sell options, and if the stock does nothing, the options will reduce in value because now the big event is over, and there's less likely to be a large move after that. So, but that's a good point. I think that was Lee.
It was, yeah.
There's the chat.
It was Lee.
Yeah, and that's true. The farther you go out in time, the more options cost, because you're basically buying time for your thesis to be correct. So let's say you're a long-term investor with Apple and you're like, okay, I want exposure. I want long deltas with Apple, and I want to be in it maybe the next year or so. If we go to, let's say we buy it at the money strike again. If we bought the 30-day option, that 133 strike is $5. But if we want to be in it for, let's say, a year or maybe close to 275 days, Jan, that same 100, they don't even have that strike. Sometimes the strikes aren't available. So let's compare the 135. Let's go back to, so here the 135 with 275 days is about $13, or it'll be $1,300 for that option. As opposed to the $30 135 is going to be $4. So you do pay more for options that are farther out in time, because that you have more exposure, you have longer exposure to the deltas, because the stock could continue to go up. If it's a bull market, the stock could just keep going up and you'll be able to participate without having to worry about the options expiring. And the theta tends to be a little bit less as well with that. So real quick, let's switch over to puts. Let's change our opinion of Apple, and let's go to the chart. So let's say we think, they just had an Apple announcement. They got a bunch of new pretty colored iPads and stuff, and we just don't think, for whatever reason, we think Apple's going to go lower. So if we want to get bearish exposure, we know we can. We could sell a call. We sold the 145 call that just says, hey, as long as Apple doesn't go up, then I can make a little bit of money. But what if you really you have the conviction that, I think Apple's going to crash? Well, in that case, you probably want to go over to the put side of the aisle, and we'll just stick with the 30-day example. And let's say we think Apple's going to tank on earnings next week. So we buy the 134 put for $5. We now have negative delta, meaning we make money when the stock goes down. And we have negative theta, meaning that the option will lose value over time. So time's working against us. And we would want the market to crash. Well, this might make sense. If you're bearish on Apple, and you think Apple's going to crash over the next 30 days after earnings, then you could have negative delta and or get some negative deltas by buying this option. So we look at the curve. Right now, the stock is trading right here. If the stock does not move lower over the next 30 days, you're going to lose the entire premium, because we bought the, the 134, and we would need the stock to go down to about 129 to be profitable at expiration. Now, if the stock moved down to 129 tomorrow, let me move this out of the way. Why is that? There we go. Our break-even point is right here around 128.87. If the stock were to fall to 129 or 128 or so over the next day or so, we could make a few $100s, and then we have, ultimately a ton of exposure to the downside that we could make money. Sometimes the zoom on this thing's a little bit weird. If the stock really tanks down to $60, which is very unlikely, you can make a lot of money here if you're right. But again, we only have 30 days, so the stock's only going to move so much in 30 days with this particular option. And we would need it to move to at least 128 to make money if we were going to hold it to expiration. So this is a more of a directional bet, whereas selling that call option, even though they're both bearish in a sense, with buying the put option, you really need the stock to move. But when you sold the call option, we sold the 145. When you sell the call option, you don't need the stock to move. So you're going to make less, but you don't need the stock to do anything. So again, this goes back to expressing your own personal opinion about the market, what you think it's going to do, and finding the right combination. And I think using a tool like this lets you visualize where your risk is, how much you're risking, how much you can make. And I think it's very helpful to me and how I trade. If I just look at the chart, even with buying stock, like sometimes I like to look at that risk profile to get an idea of where my risk is. So that's all I really wanted to cover tonight. Does anyone want to review any of that, or they have any questions? They want to go deeper into anything?
Eric, one question. On the option chain, it tells you the expected move in each period. And I think that's helpful to me when you're looking at stuff to say, how far do we really, if it really moves in your way, what's the likelihood it's going to move 20 points or 10 points? That the option chain can give you some kind of idea of that.
Yeah, this is the expected move. So, and I think Thinkorswim has this as well. So over the next 30 days, the options market is pricing in a plus or minus move of $9. So the options market is saying the stock could either go up $9 or go down $9. And some people do use that in their trading, their selection of the strikes. So I don't do that necessarily, but if the stock's at 133 and the expected move is $9, well, whatever that is, 133 minus 9 is what, 122. So if you sold the 122 put, and the stock, I got two options on there now. That's weird. If I sold the 122 put, I would be, or slightly outside or near the expected move to the downside. And I think this is pretty much right. Delta 16 is one standard deviation. Is that right? Is that how they factor that?
Yeah, that's what it is.
Yeah. So typically the expected move is based on one standard deviation.
But that
But,
blue dotted line is the one standard deviation. If you scroll up just a smidge,
sorry, say it again.
that blue dotted line that you see,
Oh,
that's the one standard deviation line.
that's one standard deviation. Interesting. Yeah, I'm still learning Tastyworks. So thanks for the tip. Now you also have this orange thing that they put in there, which is an expected move too. So I haven't quite figured out how to grapple with all that, but you know,
Do you
just
see there the second dotted line is the two standard deviations? And if
yeah,
you put it on curve view, they show up there as well.
right. Yeah, I usually take all that stuff off. Because when I'm trading, like, I mean, you know, if we trade like 1 or 2 day stuff, like I don't even look at that stuff. But yeah, there's a lot of extra tools in here to help you use the options pricing and what they're factoring in with your trading. So I wish I could speak to it more. But anybody else before I stop sharing the screen want to see anything in Tastyworks? We're coming up on the hour.
Hey, Eric, there was a question here from Geraldo asking about the theta decay rate between naked shorts and credit spreads.
Okay, yeah. So, yeah, basically it's a combined amount, right? So let's go to Apple. So I'm gonna change this to theta. So we can add the theta in here. So if you think about it, and this is where, if you're trading credit spreads that are very narrow, you're not going to see the theta work in your favor. And this is why a lot of people like to sell naked options, because the theta works a little bit more like you would expect or want it to. So for example, if I'm selling, I like to compare this to a chart. Let's just say I think Apple's going to roll over and die here, and I think 130, it's going to stay below 136. So I could come in here and say, okay, I'm going to sell the 136 call, and this would have theta here, right? Because I'm selling, it's negative. The call option has negative theta, but since I'm selling it, I actually get positive theta. So I have negative delta, positive theta, meaning if the stock does nothing, this thing will go to 0. If we go to the curve, if the stock, here's the stock. If the stock does nothing, this option will go to 0, and I'll get to keep the $355. But again, we have all this risk over here if we're wrong. So what we try to do to minimize the risk is spread it off. So if we notice the theta is 7.4, if I buy the next one, it basically is going to subtract from here. So 7.417 minus 7.2, you end up with about 0.16. So now when I go to the curve, I can make $40, but the theta is going to be a lot less. So you're going to need to stay in that trade. I mean, obviously you would need to get max gain, you have to stay in the trade anyway. But it's basically, when you're spreading it off, you're subtracting one and adding the one, and that difference is what you're getting, just like you do the profit and the actual credit you get. If you, let me take that off again. If I sell the 136 for 355 and I buy the next one for 325, the difference there, what they're probably using the mark, is about 40 cents between the two. So if you're selling one, you're buying the other, it's the difference that you get to, that becomes your credit. And it's the same with delta. If you're if you're selling 43 delta and buying 39, then that's a difference of about 3 or 4. And these only go to a certain decimal place, but that becomes your delta there. It's a combination, and adds and subtracts those together. And probably that's a different calculation. So, and now if you widen the spread out, right, instead of we're talking about theta, if you have theta 7.4 and you widen the spread out, you can increase your theta by widening the spread. So now we're making, we're making this much per day, whatever that is, 58 cents. If we widen it out, we can make more, we have more theta, But again, it goes back to the risk. How much risk do you want on the upside, right? Do you want $650 risk? If you're married to this level, you think 130, what was it? 136 is the level that Apple will not go off because that's your opinion. The question is, well, how much do you want to make versus how much you want to risk? So that's just something you have to, kind of come to terms with. And there's ways to adjust that according to your own risk tolerance, your account size, and all those things. But what I will say is the narrower the spread, the less delta and less theta that you get. So you typically have to stay in the trade a little bit longer. If you watch Tasty Trade and Option Alpha and all these guys where they try to take 50%, they'll try to close the trade out once you can book 50% of that credit. It takes you longer to do that with a narrower spread. With naked options, you usually can book that faster, but you got all that risk if you're wrong and you end up having to manage it. So, so I hope that answered the question.
Yep.
All right, I'm gonna stop sharing here, go back to video. All right, well, that's all I got for tonight. Hope that helped people kind of understand a little bit about risk and comparing. Especially if you've never traded options before, you can kind of see what's possible, what you can do, where the risk lies, and you can get creative. And there are a lot of ways to increase your probability, which is something we try to do. So we are going to let me check the chat. Oh, thanks everybody. So again, we're going to record and put it in, I don't know where yet, if we can put the recording in here, but we'll put the recording in here somewhere and I'll post it over the next couple of days. And if you're in the Central Florida group, come jump over to the website. Oh, I'm not sharing my screen anymore. That's why. If you guys come over to the stock options, markettrading.net and join that website, we'll post the recording in there. So,
and then Eric, we could put the link in the Winter Park Options Facebook page too. So,
yeah, we can post it in both. Because I know they allow you to embed the video now, but so I don't know how easy it is to link out. But we can put the video in both. You might be able to link out to if you make it a post or an article. I think you can share the link to it.
Yeah.
We'll have to figure that out.
Yeah. And there was one, RJ asked, are we any plans to do intermediate or advanced topics? And yeah, we kind of vary all over the place. We do, sometimes we do too many advanced stuff and then the beginners so we try to balance it. So this was definitely more, basic stuff, but also very important. So I appreciate you doing this, Eric.
Yeah.
Great job as always.
Thanks for coordinating. Yeah, and we're open to requests too. If there's,
Definitely.
a particular strategy, how people are trading. I know, people are posting in Winning Wednesday, and if they're posting credit spreads or, there's all kinds of spread butterfly. I've been doing a lot of broken wing butterflies on short-term trades, like 1 day, 4 day, 2 day. So we can definitely get into more strategies. I know this is a little bit more of a basics course, or class, but we could definitely get into more advanced stuff. So we're open to requests and, whatever you guys want to do.
It would be nice to get a feel from the group if they're interested in learning more about strangles and calendars, or if those are just topics that are too far out for most.
Yeah, we can do a poll maybe next time. I don't know if Brian's got any more speakers lined up, but we could do a poll in the group about what they would want to see. And then we can see who would be best to present that. I know, Lee, you do a lot of strangles. That'd probably be up your alley. So yeah, we'll just, we'll get some feedback over the next week or two, and we'll get something scheduled for next month.
Yeah, we love getting feedback because otherwise we just come up with what we think. So any feedback you give us is great. We definitely, because we learn as much about, when we're presenting than, anybody listening to it. So it's always fun for us to test new stuff out.
Yeah. I'm going to I'm going to share my screen one more time because I think there were some people that came in late. For those that want to join the group, it's stock market options, trading options with an S.net. And the events will be here. And then I'll post a poll maybe next week for what we want to maybe cover for the next event. And I'll get the recording in there too. So if you're in the Central Florida Facebook group, I'm not sure how long Brian's going to keep that group around, but I think we're going to try to have everyone come over to this group because I think it'll just be easier to manage with everything in one place. But I want to just show you the website again. Okay.
Perfect.
All right.
Thanks, Eric.
Thanks, everybody. We'll see you
Good
next
night,
time.
everybody.
Great job, guys. Thank you.